This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 5 videos on trends. I'm going to begin by talking about what exactly I mean when I use the term trend. Next, I'll move on to the most important feature of bull trends, and that's that it needs higher lows. And finally, bear trends need lower highs. In a trend, prices move mostly in one direction. So here, lower left, upper right, even though the market went sideways for a couple of times. Also, trends are contained within channels. All trends are contained within channels. Some channels are very steep, but the channels are there. There's a trend line below and a trend channel line above. The trend channel line can be simply a parallel of this line, or you can draw the line connecting tops. Now, I said every trend is contained in a channel. The channel might not be all that obvious, but it's there, and it's important to learn how to recognize it. This is a bull trend bar. Bull trend bar. A trend can be as small as a single bar, and it could be as large as the entire chart. Here we had a trend lasting 2 bars going up, and then many bars going down. When I use the word trend, I'm talking about a major trend, even though I don't always say major. And there are at most 1 or 2 of them on the chart at any one time. If you see 3 or 4 trends on the chart, those trends are minor, and I usually don't use the term trend to describe them. I usually refer to them as swings or legs. Here we have a bull trend. Is this a bear trend? I would call it more of a bear swing. It's about a 50% pullback of this bull trend, plus it's much less strong than the bull trend. And is this a bull trend? Again, I would call it a swing. It's less than half of the bars on the chart, and it's not particularly strong. So to me, this is a bull trend followed by a bear swing and a bull swing. I said that a bull trend has higher highs and higher lows, and it's contained within a rising channel. The bottom line is the trend line, the bull trend line, and the top line is the trend channel line. Trend line, channel line. Some people refer to both as trend lines. So some people will say this is the bottom trend line, that's the top trend line of the channel. I usually refer to the upper line as the trend channel line. In general, traders like to put their stops below the bottom of the most recent major higher low. Here we have a major low. We don't know if it's a higher low, but it's certainly the start of this bull trend. And traders like to put their stops just below there if they're buying. Is this a major higher low right here? No, I talked about this in earlier videos. A major higher low is one that has a very strong bull breakout and usually results in a new high. And this did not get to a new high, and it's not a very strong bull breakout. So it's a minor higher low right here, and that is not a good location for a stop. You still keep the stop down here. Whether you're swinging or scalping, your stop is down here. Again, don't put your stop below minor higher lows, because too often you'll get stopped out and the market will then resume up after going below your stop. Stop below here, 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 all are bad stops. The correct stop is down here. Again, it doesn't matter if you're swing trading or scalping. This is where your stop goes, below the bottom of the last strong leg up. So if you put your stop below this bar or below that bar or below this bar, you would have been stopped out, yet the trend would have continued. This is not enough to change the premise that the market is in a bull trend. It's a pullback, you can call it a trading range, but it's still in a bull trend. I'll raise my stop if the market reaches a new high or if there's a strong bull breakout. One bar usually is not enough, but here we got a couple decent bull bars and a new high. And this low followed these lows. It went to a lower low. Most bulls would conclude that if we go to a new high and drop below this low, we're no longer in a bull trend. We're not necessarily in a bear trend, but the bull trend has ended. Traders would then view the chart as being either in a trading range or possibly in a bear trend. This is a good location for a stop after you have this bull breakout. A lot of traders might still keep their stop down here, but most would not. After you get a new high with a couple decent bull bars and you're getting a failed breakout below the trading range, that combination of factors is enough to make this a major higher low, and the bulls should not allow the market to fall below it if their premise of a bull trend is still valid. I said that if the market falls below a prior higher low, it may be converting into a trading range or a bear trend. But if it falls below a minor higher low like this, all it's doing is converting into a flatter bull channel, a broader, flatter bull channel. We have a very tight bull channel here, but at this point we start going up. The channel now is broader and flatter. This is what I mean. I mentioned that bull trends need higher lows. They're even more important than higher highs because the higher lows determine where traders put their stops. So if the market falls below a prior higher low, below here, it can still be a bull trend, but it might be a broader, flatter, weaker bull trend closer to converting into a trading range. And it's possible that it could even be converting into a bear trend. Typically, though, when you have a trend that's strongly up, it's not going to go directly into a bear trend. It usually first has to convert into a trading range. So we got a strong bull breakout to a new high. So this then becomes a major higher low. Once you see this, bulls raise their stop from here to there. So they trail their stop, they tighten their stop. This is not going to convert into a trend in the opposite direction by falling straight down. Probably the best the bears get is a trading range, and they usually typically need at least a small double top. If you're a bull trend trader and you see this, we have a double top, you can call it a wedge, 1, 2, 3, decent bear bar, bad follow through, but no bull bar, some more bear bars. So now you have 6 bars down, 5 bear bars, and you fell below a major higher low. Probably the bull trend is over, and probably the market is either in a trading range or a bear trend. It's about a 50% pullback from this rally. So the bulls will stop themselves out as the market falls below that low. However, it's still probably at least a trading range. The bears probably will need a major trend reversal if they're going to convert it into a bear trend. And that's what they got. They got a wedge lower high, 3 pushes up, 1, 2, 3, wedge lower high, decent sell signal bar, and they converted it into a bear trend. It still could be a large high 2 buy, leg 1, pullback 2. It's holding above this low, but I think most bulls get out below that low or above this bull bar, and bears would short somewhere in here, or they would short this wedge lower high for a swing down. Bull trend, in this case, it's a fairly broad bull channel. We have higher highs all the way up. We have higher lows all the way up. And after each strong breakout to new high, bulls will raise their stop to below the most recent higher low. And you can see, after each strong breakout to a new high, when there's a pullback, it did not fall below the most recent higher low. This did not fall below that. And then a strong breakout to a new high, major higher low. Market tried to reverse down, terrible follow through. It became a bear trap, and the bull trend resumed. So each reversal attempt held above the most recent prior higher low. That's one of the hallmarks of a bull trend. In a broad bull channel like this, you often have pretty strong sell-offs. We have many of them here. And sometimes the sell-offs are even strong enough to convert the market into always in short. In other words, an early bear trend. However, unless the bears are able to get below major higher lows, even if it becomes briefly always in short, the odds are the bull trend will continue. I would say that this market was not short. I think even though we had pullbacks here, 10 bars, 15 bars, I think it stayed always in long because the bears failed to get consecutive big bear trend bars. They have two bear bars here, but a tail and followed by a bull bar. So to me, this is not enough to convert the market to always in short. Sometimes when you have a broad bull channel, the market will sometimes become always in short, yet the market can still be in the broad bull channel. I'm always drawing lines on charts. You start with what you have in front of you. As more bars get added to the right, you have to adjust your lines. The lines are rarely ever perfect. At this point, I'm using these lines, but then the market falls below here. Then I use this point for my line, but it's still a bull trend. It's just flatter. It's not as vertical, and it's also broader at that point. So you can see here, we fell below the blue line, so now we have a new low, market rallied. This is now my trend. And we fell below that line, so when it starts up, I'll replace this line with one down here. And when you get to the bottom of channels, bulls like to buy reversals up. So they buy above this bar, and they buy above this bar, and they buy above that bar or this bar. I said that we had reversal attempts repeatedly in this broad bull channel. None of them was strong enough to convert the trend to always in short. And the bulls expect all of these reversal attempts to fail. So when they see a bear reversal attempt, what are they doing? They're buying. Anytime there's a broad bull channel and it pulls back somewhere into the middle of the last leg up, bulls buy. Okay, we have a rally, pull back somewhere in the middle third, bulls buy. A rally pulls back to the middle third of that last rally, a buy. Rally, pull back somewhere into the middle of that rally, bulls start looking to buy. And then they tend to take partial profits at new highs, and that's what in part creates the pullbacks. And bears see something really important. So let's say you're a bear and you see this right here. Okay, a new high and a pullback that fell below this high. Well, what are you going to do if you're a bear? Well, you'll see this high. You're going to place a limit order to sell at that high, betting that we'll drop back down below this high, because that's what we did before, and trends tend to weaken as time goes on. So bulls are buying pullbacks to the middle third of the last leg up, so they buy somewhere in here, and bears are starting to sell new highs, and bulls sell at new highs as well to take profits. And bulls like to see these reversal attempts. As long as the market's continuing to make higher lows, they assume the trend will continue. So whenever they see a reversal attempt like this or that or this, guess what? They buy it because they expect the reversal attempt will fail. So the bulls will buy bear closes and they'll use the appropriate stop. A bull buying this close, his stop is below the most recent major higher low, and he bet that the bear reversal would fail and that the trend up would continue. Same with here. You could buy that close. You could buy below that bull bar because it's a bad looking sell. You can buy that bear close. Another attempt to reverse. You buy that close. I wouldn't draw this as a trend line here, here, and extend it across. However, either one of these you can use for the first point of a line, and then here's an obvious second point. We reverse down. And to find the bottom of the channel, you could either simply use lows, like draw a line from here to here, or you can use a parallel line. At this point, we know the market was turning down here. Maybe it'll fall to the bottom of a channel that is created from a parallel of that line. Once we start to turn down here, a lot of traders can see an obvious top of a channel, and they'll create a parallel of it and drag it down to a bar that contains all of the bars. Would I drag it to this bar? No, because these bars would then be below the channel. I want to drag it down to the bar that would result in the channel containing all of the bars. And then traders will look to buy a reversal up. Channels are rarely perfect. There's usually some problem with every channel, but it gives you an idea of what the market's trying to do. And if the market's near the bottom of a channel, traders look to buy for a reversal up. And if it gets near the top of a channel, they look to sell for a pullback. Just like a bull trend needs higher lows, a bear trend needs lower highs. Bear trend has lower highs and lower lows, and is contained in a falling channel right here. So here we have a spike down, a pullback, and then a bear channel. Now, this is a major lower high. We have a reasonably strong breakout to a new low. A lot of bears will put their stops above that high, and I cannot tell if this went above that. It looks like it might have. And if a bear did exit on a stop above that bar, he would look to sell again on a reversal down because of a possible double top bear flag. So double top bear flag, neckline, looking for a measured move down. The top of the channel is the bear trend line, and the bottom is the channel line. So bear trend channel line. In a bear trend, bears want to put their stops above the top of some major sell-off. Here we have a very strong bear breakout, so bears selling anywhere this close at the market, above this bar, below that bar, doesn't matter. Their stop is still above this high. So it's above the most recent major high. Let's say we're at this point. Is this a major high? Will bears lower their stops from here to here? I don't think so. That's not a particularly strong bear breakout and did not get down to a new low. The bears who shorted for any reason still have their stop up here because they know since this is not a major low, the market could easily go above it and still be in a bear trend. So we could get a low 2 or a wedge bear flag. So we can get one more slightly higher high, another slightly higher high, and still be in a bear trend. If you're selling for any reason, your stop is above the top of this major sell-off. This is a bad location for a stop. And like I said, you could easily get a two-legged pullback. One, pullback, and then two, going above that minor lower high, and then the bear trend could resume down from the low 2 bear flag. And that's what happened. One, pullback 2, we have a two-legged bear flag, a low 2 short, double top bear flag, decent sell signal bar. A bear who sold down here, anywhere in here, and then put a stop just above that lower high, lost money in a bear trend. And if the bear made that mistake, he should get short again as the bear trend resumes down. So he would sell again below that bear bar. Now here we have a low 2 bear flag, a failed breakout, a failed reversal attempt. And then we broke out fairly strongly to a new low. At this close, a lot of the bears will tighten their stops. They'll say, oh, this is pretty major. We got our new low and we have a pretty decent bear bar. And that's after trying to reverse up. So the market should not get above this bar. If it gets above this bar, then the premise of a bear trend is probably no longer valid. The market would then either be in a trading range or in a bull trend. And if you're trading it like a bear trend and it has become a trading range or a bull trend, you want to get out because your premise of a bear trend is no longer valid. So after a strong breakout, this becomes a major lower high, and bears will take their stop from here and put it to just above there. Pretty tight channel. And if the market trades above a lower high, as it did here, it's probably not going to be a bull trend, but it could be a weaker bear trend. It could be a trading range, but more likely it's going to be a weaker bear trend, broader, flatter. So initially we had this as the bear trend, very tight. And then once we have this lower high, we can draw a line here, still pretty tight. And now we have a new high above both of those possible bear channels. So now we have a new channel from this high to that high. and it's broader and flatter than the other channels. Here we got a bear microchannel, so it's a breakout on a higher time frame chart. And we have a series of lower highs and lower lows. Is this a major lower high? Probably is. Had a pretty strong bear breakout and follow through. And it made a new low. And then also we're trying to get a bear breakout below a bear channel. So if you connect these lows, that would create a bear channel. And here we're trying to break below it. That's not a good thing. 75% of bear channel breakouts, where the market breaks below the bottom of a bear channel, 75% of them will reverse up to the top of the channel or to the top of the most recent sell climax, this bar, maybe that bar. But in any case, if you're short and you are going to exit on a stop, your stop now is above this bar or above that bar. Both of those are reasonable. And what happens if you get stopped out? Is it a bull trend? No. A tight bear channel like this usually cannot then become a bull trend. Usually the best the bulls can get is a trading range. And if the bears are unable to resume the trend down, the bulls have a shot at a major trend reversal within that trading range. And at that point, the probability of the bulls taking control is better. Usually the first breakout of a channel results in a minor reversal and a trading range or a bear flag rather than a bull trend. The bears got stopped out here in a strong bull bar and a pretty good reversal, strongly down, strongly up. Probably a minor reversal. Some bears will sell below this bar on the failed breakout above these bars. Others will wait to see if we get a series of bear bars, 3 or 4 bear bars, and then sell, or if we get a micro double top. Strong enough bull bar, probably at least a minor second leg up, likely. And in this particular case, we got a particularly strong leg up. It went above all of the highs in the channel, did not get above the top of the bull trend. So what do? Well, a lot of traders would sell below that bar. 2 legs up, 1, 2, or a wedge, 1 or 1, and then 2, 3, or 1, 2, 3, different ways to draw it. We'll look at this as a possible second leg trap in a developing trading range. First leg up, pull back, second leg up, terrible follow through, and pretty bad follow through. And we did not get above this high, so this is probably a bull leg in a trading range. A lot of bears will sell that. And the bulls probably would get out because disappointing follow through despite a strong bull breakout. All trends are constantly trying to reverse. So here we have a bear trend, lower highs, lower lows, constantly trying to reverse. And sometimes the reversal up is strong enough to make the market always in long. Here we have a bull breakout above this lower high, and then a follow-through bar. Tail on top, not especially big, but probably always in long. Pretty common when you're in a broad bear channel for the market to become always in long. However, usually the bear trend resumes before the market gets above a major lower high like this or like that. Even though the market rallied up strongly, especially here, in many attempts to reverse up, every rally resulted in a lower high. So it's still a bear channel. And traders will look to sell the reversal down. Now, you have a bear bar and a follow-through bar, bear bar. Do you put the stop above this high or above that high? No, this is a minor lower high. Did not have a strong bear breakout, did not get to a new low, and therefore putting a stop just above the high of that bar is a low probability bet. You're throwing money away. You still have to rely on your swing stop. Now, what about this? Is this a good enough major lower high so bears can put their stops above it? Maybe. This is not a strong bear breakout, but it is a new low. A lot of bears will not put their stop above here. They'll keep the stop up here. If the bears do put their stop just above this bar and they get stopped out here, they'll look to sell a reversal down, either below either of these bars or below here, betting that the rally does not look strong. It looks more like either a bull leg in a trading range or a bull leg that becomes a bear flag. Bears, they see these strong rallies and they say, yeah, it's a strong rally. Maybe it's even always in long, but it did not get above the top of this major lower high, and therefore it's probably going to fail and become a bear flag. So bears will look to sell. The same with here. You say, oh, we rallied for 15 bars. That's pretty bullish. It is, but it lacked consecutive big bull trend bars closing on their highs, and it did not get above the most recent major lower high. So bears will be selling here. Again, channels are rarely perfect. You can see the way I drew it, I connected this high and that high and ignored this bar going slightly above. And we're trying to go slightly above again. Traders don't really care if it hits the channel exactly and turns down. They care that it turns down somewhere around the channel. So bears are looking to sell on a reversal down from the channel, the top of the channel, somewhere around the channel. A lot of traders prefer to sell below bear bars, so some traders would sell below this bear bar. Others would take the short below this doji bar. And then same over here. You could sell below that bull bar or below the bear bars. And here you could sell below the doji. You could sell below the bear bar. In this video, I talked about how I use the term trend. I also talked about the importance of bull trends needing higher lows and the importance of bear trends needing lower highs. As long as a bear trend is forming lower highs, traders believe the premise of a bear trend is still valid. If the market gets above a lower high in a bear trend, the bear trend probably has ended and has evolved either into a trading range or, less likely, a bull trend. And the opposite is true of a bull trend forming higher lows. If the market falls below a major higher low, the bull trend probably has ended and has probably converted into a trading range. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on trends. This is Al Brooks, and this is the second of 5 videos on trends in the Brooks Trading Course. An important point when you're looking at any chart is that if it's not particularly clear, the chart is in a trading range. Next, I want to talk about how trends can be in a breakout phase or a channel phase, and the breakout phase is the strongest part of a trend. And finally, I'll talk about the 80% rule. Markets have inertia, just as trading ranges tend to resist breaking out. 80% of breakout attempts fail within a trading range. When the market's in a trend, it's constantly trying to reverse, but 80% of the reversal attempts will fail. Look at this chart. We're strongly bearish. We're strongly bearish again and again and again. And then we're strongly bullish and again and again. So is the market in a trend? Well, if it's not clearly in a trend, you have to assume it's in a trading range. It's making strong bull breakout attempts, strong bear breakout attempts. So there are good arguments for the bulls and for the bears. That's one of the hallmarks of a trading range. Whenever the market is not clear and both the bulls and the bears have reasonable arguments, the market is in a trading range, and you have to trade it like a trading range. I said that every trading range has both bull and bear arguments. Well, every trading range also contains the start of both bull and bear trends. For example, look at this. We're getting lower highs, and if this chart continued down, you would say that the bear trend began here. Likewise, here we got a double bottom. And let's say we break above the neckline and go up for a measured move and start a bull trend. And you look back at this chart and ask yourself, well, where did that bull trend begin? You would say here. However, at this point, right here, we're still in a trading range. So it has an early bull trend and it has an early bear trend. In this particular case, we have lower highs and we also have higher lows. Just as every trading range contains trends, trends contain trading ranges. Every pullback and pause is a small trading range. And you can tell that by looking at a smaller time frame chart. Here, there's no actual pullback, but it's still a pause in a trend. Here is an actual pullback, and a pullback is a small trading range. So this is a small trading range. This pullback is a small trading range. It extended on and formed a 10 or a 15 bar trading range. Yet we're still in a bull trend. Once a trading range goes on for 20 bars or so, the probability of a reversal becomes almost as high as the probability that the trend will resume. I always look to the left, and whatever to the left is, that's what is always going to be slightly more likely the market will do at some point. So when I'm trading in here, when I'm looking at the market here, it's confusing. Are the bulls or bears in control? Well, the most recent clearly always in setup was here. The market was clearly always in long. So all through here, the probability is slightly higher that we'll get trend resumption up instead of trend reversal down. But every bar that gets added to the trading range reduces the probability for the bulls. And at some point after 20, 30, 40 bars, the probability of trend resumption up falls to 50%, and the probability of trend reversal down rises to 50%. I talk about always in trading, and if the market is clearly always in short, it's far easier to make money selling. So it's better only to look to sell. We're trying to reverse up repeatedly, but the channel is very tight. I don't have the lines drawn, but it's a very tight bear channel. So all of these reversal attempts are minor, which means they'll lead either to a bear flag or a trading range. So traders look to sell every reversal down from a pullback. This bar pulled back above that high, so it's a pullback, below one short. Here we pulled back for a few bars, and it's a short here. You can also call it a double top lower high. And here we pull back for a few bars. So it's far easier to make money selling when the market is clearly always in short. Also, it's easier to make money if you swing trade. If you sell for any reason, here or here, it's better not to take quick profits. If you're a very skilled trader and you can buy back your shorts and then sell again, buy back your shorts and sell again, you'll do fine. But very few traders can do that. And when a channel down is this tight, it's far better to take any short and just hold until there's a clear end to the trend. For any trade, whether you're in a trend or in a trading range, you should always have protective stops. And they can't be simply in your head. They have to be in the market. Let's say you buy above this bar. You might immediately place a stop here. It's a 50% pullback, a very strong reversal up, high to buy. Most bulls will not let it fall below this bar. And if it does, they'll question whether it's still in a bull trend. So the bull immediately places the stop there. The bears will look at this and say, oh, we were trending up, and then we got a bull breakout above this tight bull channel. So we're trying to get a bull breakout above the tight bull channel. It's an exhaustion bar. Every big bull trend bar is an exhaustion bar. And the gap closed. The gap between this close and that high, we closed it over here. So maybe the bull trend has ended, and maybe we're in a trading range. Maybe we're, in fact, in a bear trend. The bears will look at this as a lower high, not enough bars for a major reversal, but certainly enough bars for a minor reversal, a swing down. And the bears will look at this as a double top lower high. In any case, the bulls who buy here cannot have a protective stop in their heads. They have to have the stop in the market just below the low of this bar, because sometimes you get this. It happens often enough. And if you don't have that stop there taking you out, you'll keep coming up with reasons why you should continue to hold on to your long position, hoping that it will reverse up. And you cannot do that. A breakout is the strongest type of trend. It can be one bar, it can be many bars. The bars are really scary for beginners. They look at this and the market's not doing much of anything at all. So it's pretty peaceful watching it. And then you suddenly have to change your way of thinking when you see a big bar like this. Far bigger than all the prior bars, 10 times bigger, closing far above the high of all the other bars. So we're no longer in a tight trading range. We're now in a trend, very strong bull breakout. High probability that we're going higher. But here you could use very small stops. The bars are small, the market sideways. Here you now have to use a wide stop below that bar, below this bar, probably below all of the bars. It's very easy to miss the trade. You're denying that it's the start of a trend. Well, chances are it is the start of a trend. Chances are that means high probability that it's going to continue higher, high probability of a profit if you buy. Yet stop far below, so risk is great. And that's always the case. Whenever you see something that has a high probability of predicting something else, like higher prices, your risk reward is going to be bad. Usually your risk is big because the stop is far away due to how fast the market moved up. You have to get long. Even if it's a small position, you have to get long. And what I talk about in this course constantly is ways to get long. You have to train yourself to react reflexively. You see this, you know the market's no longer in a tight trading range. The market has changed. You need to get long, and you can simply buy closes. You can buy the close of the breakout bar. If you want higher probability, you wait to see if the next bar has a bull close, and then you buy that bull close. And how do you buy it? You can just hit the button, buy the market. Or you could place a limit order as soon as this bar closes to buy at the close of that bar. But the easiest thing is when you see that second bar having a bull close, just hit buy the market. Again, stop is far away, so you're risking a lot more money. You have to trade smaller. You can put your stop below the breakout bar. If this is going to be a successful breakout, it should not trade below such an exceptional bar. You could also put it below the entire bull leg. Both are reasonable. And the odds are, whenever you see a breakout that is as big as this, it's going to result in some kind of a measured move up. Maybe simply based upon the open of the bar to the close of the bar, measured move up here. But it certainly has at least a 60% chance of resulting in higher prices and some kind of a measured move up. I think one of the hardest things for a beginner is all they think about is risk. I can't lose money. I work so hard to get this account so that I can trade. And if I lose my money, I lose my trading career. I die. My trading career has died. So all they focus on is risk. And because of that, they're always looking for the tightest possible stop. And they're also always waiting for pullbacks because they think, well, I don't want to buy up here because my stop is too big. I can't afford to risk that much. While they wait, the trend can continue up a long way. They have to get used to just buying at the market. They see the market's going up, tight channel. It's a breakout on a higher time frame. You just buy at the market, put a stop down here, go for a walk for 15 minutes. And if that's what you have to do to stay in the trend, because this tight bull channel is a breakout on a higher time frame chart, that means the odds are we're going higher. That beginner now, his stop is all the way down here, so his risk is even greater. So he's even more afraid, and he's going to keep waiting for a pullback instead of looking at the chart and saying, wow, this is going up, and it may keep going up. I should just get long. Well, the beginner is hoping for that pullback, and he misses a whole rally. If you are a bull and you're long for any reason, let's say you bought somewhere down here, your stop is down here, and that stop is probably much bigger than what you typically use. And that means your risk is greater than normal. So what do you have to do? Well, if you're a computer algorithm, you have to do something to make sure that your risk does not get too big. The easiest thing to do is to reduce your position size. So even in a strong bull trend, bulls have to take profits at some point to reduce their risk. And when the bulls take profits, it creates a bull flag. However, beginners don't see it that way. When they see that pullback, they see a trend reversal, a reversal into a bear trend. This is profit taking from the bulls, trying to reverse, trying to reverse, trying to reverse. See, it went up and down, mostly profit taking from the bulls. It's a mistake to be selling even with limit orders when the channel is this tight. All of these reversals are mostly profit taking from the bulls. And as soon as it comes down a little bit, other bulls who have been waiting for a pullback are buying, even if it drops just one bar below the low of the other bar. Here, one bar below, one bar below, one bar below. Traders who are flat or who do not yet have a full position are buying even the smallest pullbacks. That means there's a lot of urgency on the part of the bulls. If you get a big enough pullback, what becomes a major higher low, computers will tighten their stops to below that major higher low. And then anyone who buys after that point they have a stop that is higher up, so the risk is less. So look at this trend. We have 1 and 2 bar pullbacks all the way up, and they do not drop very far, and the market keeps working higher. The sell signal bars do not look all that strong. When the bulls look at all of these reversal attempts, what they see is a bull flag forming, and they're looking for a reversal back up. So they're expecting the reversal down to be just a bar or two, and the bulls will buy with stops above the reversal bars, the bear breakouts. And the beginner looks at it and says, oh, that's still too high for me to buy. I want more of a pullback. The beginner does not take the trade. He says, my stop still has to be down here, and I cannot risk that much. And what he should be doing is buying small, and just buying the tiniest position that he could buy at any point. Take any one of these high one bull flags and use the appropriate stop. So the beginner ends up missing a trend that goes on for 10, 20, 30, 40 bars. And the beginner oftentimes starts to think, okay, this is going on way too far. It's unsustainable. It's climactic, and therefore it should reverse. The trend cannot last forever. All strong trends are constantly forming wedges. 1, 2, 3, 1, 2, 3, 1, 2, 3. However, when the channel is this tight, all of those wedges are going to fail. The beginner only sees the wedge. He doesn't see the tight channel, and he does not see the low probability. So that beginner who did not buy any of this now sees a reversal down, and he says, okay, a lower high, I got to sell. Maybe we'll get leg 1, leg 2, measured move down, leg 1, pull back, leg 2. And my stop is small. So if I sell below here, maybe my stop is here, maybe my stop is here. So I'm not risking very much. Yes, he's not risking very much, but he has terrible probability. When you have a tight bull channel like this, the first reversal down is minor, and the bulls will buy it. Here we have a first reversal down, and guess what? Strong bulls are going to buy it. So that beginner who's been waiting for his pullback finally has his pullback, and he's selling far below the high, far too much below the high, and he's selling where smart bulls are just waiting to buy. So maybe the beginner will sell this bear flag and put a stop just above the high of that bar because he wants to reduce his risk. And that's just a terrible mistake because most reversal attempts fail, and this, I think, is a bull flag and more likely to go up. If it keeps going down for 20, 30, or 40 bars, then the probability is that we're in a bear trend, even though we did not have a major trend reversal. But at least 70% of the time, when you have a channel this tight and you get a bear breakout, it's going to be a bear leg in a trading range, and the bears will need a major trend reversal. In other words, they'll need one more attempt to resume up, testing this high, and then a second entry short, double top. First reversal down, and then a rally and a second reversal down. And without that, chances are any reversal attempt is going to be minor, and the bulls will buy it. 80% rule. If the market's in a strong bull trend, it's always going to be forming tops, usually wedge tops. But 80% of the tops will fail. Here we got different ways to draw a wedge top. Talked about that a few minutes ago. And the beginner selling this lower high is betting on, well, maybe it's not quite a major reversal, but it's certainly a big reversal after a buy climax, and therefore we should fall further. No, that's not true. Very tight bull channel, first reversal down, probably bulls will buy it. Bulls were buying 1 bar pullbacks for 10, 20, 30 bars, and now they get a chance to buy a 5 bar or 10 bar pullback. Well, a lot of them will take that chance. If they were willing to buy a 1 bar pullback, and now they get to buy a much bigger pullback, and there's no clear, convincing top, they're going to buy. So the bear selling down here is selling at the bottom of what is at best a trading range, and at worst, it might be a pullback in a bull trend. Most of these tops become bull flags, and here you can call this a wedge bull flag. You can call it a high 2, you can call it a small double bottom. Different ways to draw the wedge. We got a slight pullback here, so first push down became a doji, and then second push, third push, or you can say first push down, second push down, third push down. Doesn't matter. A bear channel is a bull flag, especially in a bull trend. Bulls are going to be buying a reversal up from that bear channel, expecting the trend to resume up. So that bear who took this short below that bar and put his stop just above at this yellow line because he did not want to risk much, lost money. The probability was probably 80% that he was going to lose money. So yes, he took a low risk trade. He did not lose money, but when he takes this trade, he's going to lose 80% of the time. And the 20% of the time that he wins, he will not manage it well enough to overcome those losses. So in a strong bull trend, the first reversal down is a bull flag, not a reversal. Yes, the beginner says, okay, well, at least I did not lose much. Well, if you lose a little bit of blood 1,000 times, you've lost a lot of blood. These small losses add up, and you can end up losing a lot of money. Now, that beginner might think, okay, it's way overdone, and this didn't work. Now we got 2 legs up here. Maybe it's a wedge, 1, 2, 3, and maybe a second entry short up here is worth taking. While it's a credible higher high major trend reversal, bull trend, bear breakout lasting a lot of bars, 10 or more bars, and then resumption up. And then we got a second leg up from here. This was likely to have a second leg. Well, we have it. So there are decent reasons to sell, except one. Very tight bull channel. A bear reversal is probably going to be a bull flag, and we're going to resume up. And how big are the pullbacks up here? Really small. You can also call this a tight bull channel, and therefore the reversal down will probably fail. Even though this is a second entry sell, first entry, second entry, failed breakout, new high, it's still not enough selling pressure. Where are the big bear bars? Where is the evidence in the past 20, 30, 40 bars? Where's the evidence that the bears can take control? This is not much evidence. Yes, it's a short, and it's a reasonable short, but it's a very low probability short, and I would not take it. I've talked about this before as well. So you're taking a short, your stop is above this bar, and you say, well, at least my risk is small. Whenever you have a very small risk, you always will have low probability. In other words, anytime you take any trade and you're using a very tight stop, you probably are going to get stopped out for a loss. You can say, well, it's a major trend reversal, so if it reverses down, I'll get a major profit, a very big profit, and that more than offsets the low probability, which is true, but it assumes that the low probability bet will be successful and that you'll manage it correctly. And most beginners will not. They'll get out with a small scalp profit, which means they're taking small reward, and that neutralizes their small risk. So they still have a weak risk reward, and they're taking a low probability bet. So low probability and not a strong risk reward setup, you're going to lose money. What's going to happen to this bear taking this low risk trade? He's probably going to get stopped out. And he did. Okay. That beginner might keep arguing, well, it's got to turn down at some point. It's way overdone. It just cannot keep going up. Probability has to be getting higher. He knows low probability, low probability. All he cared about was risk. And he's assuming that eventually the probability will go up and that he'll make money. Now we got a wedge, maybe a nested wedge, 1, 2, 3, or nested into a larger wedge, 1, 2, 3. So that's certainly higher probability. And look, the risk is small again. So if I sell below that doji, I get filled on this bear bar and my risk again is small. But small risk usually means low probability, and a pretty tight bull channel, low probability. Bulls probably will buy. It's a credible higher high major trend reversal short. I would not take it. Just not enough bear bars anywhere on the screen to be selling, especially selling with stops too far below the high. That bear sells below this bar, his nested wedge. He gets filled right there on this bear bar, and he sees this bear bar and he's happy, thinking that, okay, this is a higher probability short. It might be, but it's still a terrible short. Chances are bulls will buy that bear close and that will continue higher. Bulls will either buy the bear close or they'll wait for a bull follow-through bar, bad follow-through, a failed bear breakout, and they'll buy just above that bull bar, betting that the trend will continue. Like I said, 80% of reversal attempts in bull trends fail. Here, here, here. You just count, look at them all. Look at all these reversal attempts. Yet the channel up is tight. There's an absence of big bear bars. The odds are every one of these reversal attempts will fail and the trend will keep going higher. Unfortunately, a beginner will look at this and he'll keep seeing wedges. Now we got a new wedge, 1, 2, either one of these bars, or 3. And we're starting to get a pretty strong reversal down. So maybe I'll sell that close or sell this close, arguing discipline. I have to be disciplined. I have to stick to my plan. And my plan is that I have to keep shorting this buy climax because it cannot last forever. And my losses are small. Losses are part of trading. And certainly each following reversal attempt will have higher and higher probability because trends tend to weaken. And here we got a bull breakout above a bull channel and a reversal down. So that's certainly higher probability, but it's still a low probability bet. Trends just tend to keep going up, and it's much better to keep buying bear closes, betting that the trend will resume back up and that these reversals will fail. So the beginner sees a bear bar, sells here or sells here, stop just above, and he gets stopped out. The bull trend is just way too strong. The pullbacks are too small. They're too brief, and it's clearly still always in long. Traders should only be looking to buy. A huge bull trend day, yet the beginner lost money because he kept betting against the trend. Trends are always trying to reverse. They're always forming wedge tops, but they also can go a lot further than what traders think they possibly can do. So 4 losses, 1, 2, 3, 4, and they add up to a big loss. So a trader lost money during a very strong bull trend because he kept shorting all day, ignoring the low probability. All he sees is a tight stop and small risk, and therefore I'm going to take the trade. But you need risk, reward, and probability to take a trade. And anytime you're taking a very low probability trade, by definition, if it's a low probability win, it's a high probability loss, you're going to lose most of the time. You will lose. So when a trend is strong, clearly always in long, you should only be buying. Why do markets exist? They exist for one reason. They allow people to trade at a fair price. And although you thought the price was too high, the buyers thought it was too low and it kept going higher. They need someone to sell to them, and you eagerly volunteered. And you cannot do that. Whenever a trend is very strong, you don't want to be the only person selling. In fact, you don't want to be selling at all. You can only look to buy. Markets are always trying to make traders trade. That's part of why they exist. They're trying to facilitate trading. They want more trading. So they're always doing things to make people act. They're always going to be doing something that will make traders uncomfortable and make them do something. For example, it makes beginners short all the way up. However, it often has to go very far, much further than what seems rational, to find out how far too far is. And how does it know that? Buyers stop buying. Volume dries up and no one's willing to buy. And then it'll start doing the opposite. It'll start probing down. So as long as you keep selling, you'll have to keep buying back with a loss. And if it cannot go down, it's going to keep going up until there's no one left to buy. Once the final weak bears, like beginners, stop selling, the strong bears begin to sell, and you ultimately do get a successful top. And there's no evidence of that happening on this chart. So a strong bull trend, only look to buy. In this video, I talked about when a chart looks unclear and you cannot tell if it's in a bull trend or a bear trend, it's in a trading range. So anytime something is not clear, it's a trading range. A breakout is the strongest part of a trend, and it's a high probability bet that the trend will continue. 80% rule, most reversal attempts fail. 80% of reversal attempts will fail. So instead of selling in a strong bull trend, you should be buying. Instead of buying in a strong bear trend, you should only be selling. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 5 videos on trends. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 5 videos on trends. I'm going to begin by talking about the different types of trends, and then I'm going to be talking about the bull and bear versions of the trends. And finally, I'm going to be talking about traps and breakouts. Traps are failed breakouts. Trends are important because they offer a lot of profit opportunity, but traders need to understand how they operate. And for me, a good starting point is classifying them into different types of trends based upon their behavior. Every trend bar is a breakout. Every series of trend bars is a breakout. So bull breakouts here, bear breakout there, bear breakout here. And every trend is also contained within a channel, although the channel sometimes is not particularly obvious. Here we have a rising wedge channel, and we have a falling channel that is also a wedge channel. A breakout, it can be a single bar, it can be a series of bars. Trends are either in a breakout phase or a channel phase, and a breakout is the strongest type of a trend. I sometimes call it a spike, so I would call this a spike and channel bull trend. And every trend bar is also a climax. Climax does not mean the trend reverses or the trend even pauses. Sometimes a climax just gets more climactic and the market just keeps going up. Every trend is either a breakout or a channel. A channel is a weaker type of trend in which there is two-sided trading. So you get bulls in control for a part of it, bears in control for another part of it. And the way you draw channels, it's rarely perfect. The lines are rarely perfectly corresponding to the points in the channel. Every trend begins with a breakout, at least a small breakout. Here we have a gap open. So here's the end of one session, the start of another session, and we have a big gap down. And the gap immediately closed. The market had a series of bull trend bars closing on their highs. Not much overlap between the bars. As soon as this bar closed, a lot of traders just hit the button to buy the market. And you can see the open of the next bar did not fall below the close of this bar. And the same thing here. There's a lot of urgency on the part of the bulls in this particular breakout. As soon as this bar closed, traders did not place a limit order to buy the close. As soon as the bar closed, they hit buy the market. And so the low and open of this bar never fell below that close. So this is a strong reversal up, and every trend bar or series of trend bars is a breakout. Does not matter that you do not see the breakout or understand what the breakout is, but that's how you have to think of it. You can think of this as a very steep bear trend, and we broke above it. So I could draw a trend line from this high to this high, and we're breaking above it. A series of bull trend bars, good-sized bodies closing in their upper halves. Here they're closing near their highs. And it could be one bar, it could be many bars. We gap down, which is a bear breakout, and then we reverse up, a bull breakout. This is a very strong breakout, very strong bull bars. No tails on the bottom, closes on the high, very small tails on top. Sometimes a breakout is made up of less impressive trend bars. For example, we have a breakout here and another breakout here. And this one contained a doji, small bar, closing around its middle. And this one had a doji here and again here. It's not as strong as the other one, but it's still a breakout and it's still a strong bull trend. You want to see most of the bull bars closing at least above their midpoints, preferably at their highs, and it's stronger yet if there's very little pullback below the close of the prior bar, very little overlap. Most bear trends begin with some kind of a breakout. Here we got a breakout, we have another breakout here, another breakout here. And look at this bear trend. It's mostly bear bars closing below their midpoints or near their lows. And we have several series of consecutive bear trend bars. So that's relentless selling. And look at this bar. As soon as it closed, traders hit the button, sell the market. Look at the open and high of this bar. Did not get above that close. So this urgency all the way down, very little overlap, very little overlap. And that increases the chances that the market will go lower. Sometimes a small breakout can lead to a big trend. This is the euro versus the dollar, a 10-minute chart. Now look at this. There's time on the bottom. This is a 10-minute chart, and there's price on the vertical axis. It's a two-dimensional chart, price and time. It's easy to think that breakouts have to begin with price only, a big move in price. Well, they don't. Breakouts can take place over time, made up of lots of small bars, as is the case here. After 20 or 30 bars, you have to conclude that even though we're not getting huge bars, it's still a bear trend. Look how tight the channel is. Look how small the pullbacks are. They do not go up very far. They only last 1, 2, or 3 bars. And on a higher time frame chart, this is a strong breakout. We have a little breakout here, a gap between this high follow-through bar and this low, the bar before this small breakout bar. You can get a small breakout and it can lead to a relentless trend that can go on a long time. And channel, here the channel is maybe 30 bars without a pullback. Whenever you see an endless pullback like this, we have a bull trend, and initially the bull saw it as a pullback, yet it's a never-ending pullback. It's an endless pullback. And once you get 20 or 30 bars down, you have to be thinking at some point the bulls give up, and you can get a big bear breakout that becomes a measuring gap and leads to a measured move down. Here, the bulls finally gave up. So it's no longer a bear channel, bull flag. It's now a bear trend. We have a big breakout bar and a big follow-through bar. Typically, that's what happens when you have an endless pullback and finally the bulls give up. Usually you get a pair of big bear bars closing near their lows, and it usually becomes a measuring gap, and the market typically falls for a measured move down. Here we have what the bulls think is a bull flag, but it just keeps growing, growing, and growing, and then we have a breakout below the bottom of what was a bull flag, and the market fell for about a measured move down. So it's no longer a bull flag once these two bars come, and now everyone concludes that it's a bear trend, and it probably will fall further, and this probably will end up as a measuring gap. There are many different types of trends, and they behave differently. So it's good to distinguish the differences among the different trends because you trade them slightly differently. In general, especially if you're starting out, it's better to only swing trade. Once you think the market is going up, here we got a bull breakout and small double bottom, this bar to that bar, a bull close. So you buy there and you stay long until there's a good reason to get out. And this is not a good reason. Neither is this triangle. 3 pushes up, 1, 2, 3. And these reversals are not strong enough for the bears to take control. So the bulls hold long. You need a good reason to exit. And these are not good reasons to exit. Trends behave the same on all time frames. And it doesn't matter what time frame you're using. On intraday charts, I use some names that are different, but there are corresponding types on the daily chart. So sometimes if we gap down here and just started trending up from the open, I would call it a trend from the open, bull trend. On a daily chart, instead, I would probably just call it a tight bull channel. And if this were a 5-minute chart and this was the open of the day, I would just call it a trend from the open bull trend, or possibly a small pullback bull trend. Now look at this chart. We have a spike, pullback, and you can call the whole thing a channel, or you can call it another spike and channel, or another spike and channel. And just about every trend at some point has a spike and channel pattern. It has a breakout and then a channel. If this is a gap down open, or if this is the open of the day, and we did this, you could call it a trend from the open bull trend. It's clearly the spike and channel bull trend. And again, almost all trends have some component of a spike and channel to them. But if this is a trend from the open bull trend, they happen about once a week on an intraday chart. It could also be a trending trading range day where the market breaks out and then forms a big trading range, although in this case it has not yet formed a trading range. You can argue there's a trading range here, trading range here, trading range there, and it's a trending trading range day. Typically, a trending trading range day just has a couple trading ranges, and if you start to get 4 trading ranges like this, I don't use that term, trending trading range day. Instead, I would call it a spike and channel bull trend. I would call it a trend from the open bull trend. If this is the open, it clearly trended from the open. And I would also call it a spike and channel bull trend, where this is a spike and then channel. We had another spike within the channel, forming another channel. Is it a broad bull channel? Well, it's fairly broad, so you can also call it a broad bull channel. And there are other types of broad bull channels like wedges and stairs. If it's a small pullback bull trend, this is really not a good example because the pullbacks are too deep. Small pullback bull trends are the strongest types of bull trends, and they occur a couple times a month. This is, I think, more of a spike and channel bull trend. Spike here, or you could say the whole thing is a spike and then starting to channel up. And I would not call it a trending trading range day. It's also a broad channel. The pullbacks are fairly deep, and it spends a lot of time going sideways. That's characteristic of a broad channel. On the downside, we have a bear breakout and then a channel. A bear breakout, pullback here, bigger pullback here, and then a channel. Again, most bear trends have a spike and channel bear trend within them. If this is the open of the day, then it's also a trend from the open bear trend. And here we had a trend and a trading range, and the bear trend resumed. It's also a trend resumption bear trend. All bear trends have a spike and channel component. Is this trending trading range day? Not really. We only have one trading range. We have a breakout, did not form a second trading range. Is it a broad bear channel? Well, not really. You can argue that this is a broad bear channel, but to me, this is more of a strong breakout, trading range, and then another strong breakout. Is it a small pullback bull trend? No, this pullback is too deep for this to be a small pullback bull trend. I would call this a spike and channel bear trend. If you want, you can call it a trend resumption bear trend. Let me talk a little bit more about bull and bear trends. There are many ways to classify trends, but usually one is the dominant type on a chart. If this is the open of the day, you can call it a spike and channel bull trend. You can call it a trend from the open bull trend. You can call it a tight bull channel. It is pretty tight. You can also call it a trending trading range day. We have a trading range, a brief breakout, and another trading range. The pullback overlapped the lower range, and then we resumed up again. Again, all trends begin with some kind of a breakout, and then it has a pullback here, or you can call this whole thing a pullback, and then you get a channel. So here we have a breakout, a spike, and then we have a channel. And again, sometimes it's not obvious what the channel is. And did the channel begin here? Did it begin here? Did it begin there? It doesn't matter. Some computers will use any of those three. Bear trends also usually can be classified more than one way. This is a good example of a small pullback bear trend. If this is the open of the day, it's a trend from the open bear trend. Very tight channel here, so it's a breakout on a higher time frame. It's a spike and channel bear trend. Look at the pullbacks. They only last a bar or two. and the market just continues down in a very tight channel. So it's a tight bear channel, and it's also I think, a small pullback bear trend. I would call this a small pullback bear trend. All the pullbacks are really small. It's the strongest type of bear trend on a higher time frame chart. This entire sell-off is a breakout, a bear breakout. Again, a bear micro channel lasting about 10 bars or so. It's a breakout on a higher time frame chart. It's a spike, and then we have a pullback, and then a channel. So it's a type of spike and channel bear trend. And all trends have some component of spike and channel bear trend to them. But this is mostly a small pullback bear trend, and it's better to only short. I want to talk a little bit about getting trapped into bad trades, getting trapped out of good trades. Talk a little bit about breakouts as well. At some point, you look at this and you say, it's a bull trend, right? So if it's a bull trend, don't sell. Don't be selling highs. Don't be selling reversals down, especially a trend like this where the pullbacks are so small. So it's really easy to get trapped into shorts. You sell and immediately it reverses up, trapping you into a loss. It's also easy to get trapped out of longs. You say, well, it's dojis, bear bars. It doesn't look all that strong. I'll wait for a deeper pullback to buy. And the market just keeps going up. Beginners, they love to sell bull trends. Oh, maybe we're reversing. Buy climax. We have a double top here. We have a wedge here. We have another wedge here. They're always looking for reasons to sell. And there's only one reason why they are selling. It's because they are afraid of risk. They equate losing their account with death, the death of their dream as a trader. And so all they focus on is risk. They do not focus on probability. And that's a terrible mistake because some days are small pullback bull trends or strong bull trends. And yes, the risk shorting is low, small. So you sell below this bar and you're not risking much, but you keep losing. Yes, the risk is low, but the probability is extremely low. It's impossible to make money or consistent money selling in strong bull trends. Okay, so beginners keep selling, saying, oh, I'm not risking much. Selling, not risking much. But all of those small losses add up. And anytime you're taking a trade with low risk, you also are taking a trade with low probability. And it's very difficult to make money if the probability is very low, as it is selling in a strong bull trend. You just keep getting stopped out. Beginners only think about risk, and therefore they end up only selling when the market's in a bull trend because the risk is small. And they only end up buying in a bear trend because the risk is small. And they totally ignore probability, and they end up losing money because the probability is too low to be able to trade profitably. Once you think the trend is up, don't get trapped into repeated shorts. Don't be selling. You just keep looking for buy opportunities. And strong bull trends rarely have good looking buy opportunities. This is not a good looking high one. Neither is this. That's not a good looking high two. We got a bear reversal and a doji, not good looking. But the signal bars, even though they do not look good typically, they're reliable. The probability is high. So experts buy and they just decide where the correct stop is. Bull breakout, not much of a strong bull breakout here, so the stop is still down here. So you got to buy. You got to allow for the possibility of a deep pullback, but you have to buy, and you just use the correct stop and trade small. Every time you see the market trying to resume back up, you buy, and the stop is way down here, so you trade small. And then after you get a strong bull breakout like this, then this becomes a major higher low. You can raise your stop from here up to there. So when you're buying over here, your stop is now down here. And beginners, they don't buy because even buying here, for them, the stop is too far. They don't want to risk that much. So they keep shorting where the stop is closer, and they keep losing because the probability is so low. Look at this. Strong bear trend. You can only sell. But it's really easy as a beginner to get trapped into longs. You keep buying, betting that the reversals will give you at least a scalp. And you're buying because the risk is small. Maybe you buy above this bar, this bull inside bar, put a stop just below, and you say, okay, I got stopped out and did not lose much money. But if you do it again here and here and here and here, you end up losing a lot of money. A lot of small losses can add up to a lot of money. And then beginners, they also get trapped out of taking shorts because they keep waiting for bigger pullbacks to sell and they never get short. A strong trend like this traps beginners into longs. They keep buying because they're concerned that they don't want to take trades where the stop is far away, and they never short because they know the stop is way up here and they don't want to risk that much. Only focusing on risk and ignoring probability, you will lose money. The trader's equation has three variables: risk, reward, and probability. Beginners typically only think about risk and they're buying constantly, even in a very strong bear trend. They just keep buying reversals up and they get quickly trapped into a losing trade. The market resumes back down and eventually they wipe their account out. In a strong bear trend, the signal bars rarely look good. You want to sell below that bull bar? Well, it's not that good looking a sell, but it's a strong bear trend. Below this bull bar, small doji, the sell setups never look all that good. However, the chance of a reversal up is small, and if you do get a reversal up, it'll be minor and you'll test back down. Experienced traders use the appropriate stop, sell at any time, any reason, and they take these sell signals even with the bad sell signal bars, knowing that the odds are, if the market goes up, it will not go up that bar. So when you're trading in a strong bear trend and you're looking to short, you can sell at the market, you can sell with stops, but if you're taking stop entry shorts, which is fine, and most beginners should do that, the sell setups never look good enough, yet the market continues down. The key is using the correct stop, which means risking more than you might like to risk. However, that's the only way to trade this. So use the correct stop and trade very small. The beginners, they don't sell because they don't want to use a stop that far away. The risk is too big. And because they are so afraid of a stop this far away, they get trapped out of very profitable shorts and they miss the entire trend. When I see a bear channel, I immediately think bear channel, bull flag. 75% chance there's going to be a bull breakout. 25% chance there'll be a bear breakout and the trend will accelerate downward. We have a spike down, a micro channel, a breakout higher time frame, and then a channel. So channel usually evolves into a trading range. 75% chance you're going to get a break above this trend line. I think of every bear channel as a bull flag, even if it's a bear channel and a bear trend, because 75% of the time you're going to get a bull breakout. Usually not as dramatically bullish as this, but still 75% of the time a bear channel is a bull flag and you get a bull breakout. Typically when you have a spike and channel bear trend like this, so spike and channel, you get the bull breakout. It tests around the beginning of the channel. Here we went quite a bit above. And then you end up evolving into a trading range. So down and up, and then down and sideways. And then after you have the trading range, the market again decides on the direction of the breakout, up or down, and it can be in either direction. Anytime I see a bull channel, I think bear flag. 75% chance you get a bear breakout. Does it become a bear trend? Not necessarily. It can break out simply by going sideways. But bull channel, bear flag. 75% chance of a bear breakout. So I always think of every bull channel as a bear flag, expecting a bear breakout and a conversion into a trading range, sometimes into a bear trend, as it was here. And usually the market tries to test the beginning of the channel, which is down here. And you can see it fell below the bottom of the channel before the buyers came back. And so typically you get a bull channel and then a bear breakout and a conversion into a trading range. And at that point, the market decides whether to break out again to the upside or to the downside. In this video, I talked about the types of trends and why it's important to classify trends into different types because you trade them differently. I then talked about bull and bear trends. Finally, I talked about traps and breakouts, how beginners tend to get trapped out of good trades and trapped into bad trades. And I also talked about breakouts of channels. Every bull channel is a bear flag, 75% chance there'll be a bear breakout. Every bear channel is a bull flag, 75% chance there'll be a bull breakout. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on trends. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on trends. I'm going to be describing 3 types of trends in this video. The first is a trend that begins on the open. The next, I'll talk about trending trading ranges. And finally, I'll talk about trends that are broad channels. When I talk about a trend from the open, I don't necessarily mean a trend from the first bar of the day, although it often begins with the first bar. In general, the first bar of the day has a 20% chance of being either the high or low of the day. When you have a trend from the open like this, the more bars that get added to it, the more likely this ends up as the low of the day. Here, we had a gap up. I'm not showing much of yesterday, only 2 bars. We have a gap up, and then the first 2 bars are bull bars. That alone is enough for me to think of the day as always in long. That is enough to make me think that the market's in a bull trend. Even though both bars have tails, one of them has a body that's at least half as big as the entire bar, plus it's a pretty good sized body. The trend continued, traders were buying all the way up, and we had an 11-bar bull microchannel. No bear bars, no pullbacks for the first 11 bars. We also started to get consecutive bull bars closing near their highs. And when you get that on the open like this, the odds are 60% or greater, you're going to get some kind of a measured move up. For example, based upon maybe the open of the first bar to the close of the second bar of the breakout, and a measured move up takes us to around there. When you see that on the open, a gap up and then 1 bar, 2 bar, 3 bars, all bull bars, and then you start getting breakout bars, there's a sense of urgency, and that's usually a sign that you're at the start of what will become a strong bull trend. First 11 bars, traders bought at or above the low of the prior bar. They were not even waiting for pullbacks. Everyone was so eager to buy that they were buying at the market, at the close of the bar. They were hoping to buy below the low of the prior bar, but the market for 11 bars did not trade below that prior bar's low. When you have a lot of urgency on the open like this, a very strong breakout lasting about an hour or so, the market then usually goes sideways for several hours and then decides between trend reversal down and trend resumption up. Here, the market was in a trading range for 3 hours. At the end of the day, we got a little trend resumption up. When you're trading the Forex market, the open is rarely ever exact. Some days the move, for example, in the United States session, it might begin at 5:30. Other days it might begin at 6:30. Other days 5 o'clock or 4:45. So when I'm talking about a trend from the open, I'm usually talking about a market that has a single session and a clear open, like the stock market or the day session of the E-mini. I usually do not use the phrase trend from the open when I'm referring to the Forex market or any other 24-hour market. These are open basically 24 hours a day, and the sessions overlap. And the start of the sessions is usually not the same every day. There's often a breakout on a report around the start of the session, and I end up using some other term to describe the trend. For example, here I'll just simply call it a breakout. We have a bull breakout and then a channel. For me, this is a bull spike and channel pattern. And it was also a small pullback bull trend. The pullbacks were very small. Rather than calling this a trend from the open, I would call it a spike and channel bull trend. The Forex market really only has one clear open a week, but it has 3 sessions every day. Each of the 3 sessions can have a trend from the open of the session, although that open is not necessarily exactly the same time every day. For example, here, for the euro versus the dollar 5-minute chart, the start of the session usually corresponds to the start of when financial markets start to get active, and that is around 5:30 in the morning Pacific time, 8:30 in the morning Eastern time. When you get a big move like this, you can call it a trend from the open bear trend, but since it can begin at different times on any given day, I would rather simply call it a breakout. Here's again the euro versus the dollar. And here's the start of the European session. A tight trading range, a pretty unremarkable start. However, it became the high of the session. You have a small bear bar and very bad follow-through. There's some hesitation on the open, some lack of certainty. It could still be a trend from the open bear trend, even though it's beginning with very quiet two-sided trading range type of price action. If I were to use the phrase trend from the open in this market, I would call this a trend from the open bear trend. And it's still trending down from the open, even though it's sideways. And then it's starting to enter a tight bear channel, a much stronger bear trend, a breakout on a higher time frame chart. We have a 9-bar bear microchannel. 5 of the bear bars have big bodies, and they close near their lows. And there are 3 consecutive strong bear bars here. So this is the beginning of what will probably result in at least some kind of a measured move down, maybe based upon the height of this breakout. It takes us down here, maybe further. In fact, it did go further. Do you want to call this a trend from the open bear trend? Here's the start of the US session. You can. I would simply call it a tight channel bear trend or a breakout on a higher time frame chart. In any case, it's a strong enough trend. 9-bar bear microchannel, several strong bear bars. The odds are we're going at least a little bit lower. The bears are eager to sell. They're not waiting for pullbacks. They're selling before there is a pullback. So they're not trying to sell above the high of the prior bar. They're selling at the market. They're selling bear closes. They're very eager to sell. And if everybody's eager to sell, chances are even a small pullback, traders will be eager to sell it. They were willing to sell even without pullbacks. And when they finally do get a pullback, you know the odds are high that rather than a reversal up, it's going to be a bear flag and that we'll probably go at least a little bit lower. I now want to talk a little bit about trending trading ranges, a trend made up of a series of trading ranges. When I see a trading range like this on the open of the market, and the trading range is about half of the height of an average day's range, I'm assuming that today's range will be like an average day's range and that the range will double. It can double by going up for a measured move. It can double by going down for a measured move, or it can double by going a little bit down, a little bit up, a little bit down, a little bit up, and remaining a trading range day. When a day does become a trending trading range day, you have an initial range, about half of an average day's range in height, and then you have a breakout. And the breakout is usually fairly brief, sometimes a single bar, sometimes 5 bars, sometimes 6 or 7 bars, but it's brief, and then the market starts to enter another trading range. And this is a good example of a trending trading range day. We have a trading range, a brief breakout for a few bars, and then another trading range. 60% of the time, when you have a trending trading range day like this, in this case, we have a bear trending trading range day, the market comes back up at least a little bit into the other range. A bear trending trading range day, I'm expecting that the market will at some point come at least a little bit above the bottom of the upper range. 60% of the time that happens. 40% of the time it does not, and the market either stays sideways or goes down for another leg. Like all trading ranges, once you have a trading range, you got to be thinking breakout mode, and the breakout can go in either direction. Here we have a trend reversal. So bear trend, a trading range, bear flag, but instead of a bear breakout, we're getting a bull breakout. In general, once the trading range extends for about 20 bars, this one's a little bit less. Once it extends for about 20 bars, the probability of the bull breakout is just as high as for the bear breakout. It's basically a 50-50 market. Again, 60% chance that the lower range will come back above the bottom of the upper range by at least a little bit. The breakouts, when you have a trending trading range day, usually last 3, 4, 5 bars, 6 bars, and then you start to get signs of another range. You can see here we have a couple bull bars and then a bear bar, a bull bar, and then dojis. Looks like at this point we're probably going to enter another range and the day will be a trending trading range day. Once you get a 20-bar trading range, there's a 50-50 chance that you'll get a downside breakout, a trend reversal, 50-50 chance you'll get an upside breakout, trend resumption. The market is searching for a fair price. It's trying this, and traders decide that the price is too low. So we rally up in a pretty strong bull microchannel. And the rally is a search for sellers. Not enough sellers here. The market has to go higher to find sellers. I said 60% of the time, the range overlaps the range before. Well, look at this. The bottom of this range did not overlap the top of this range. And that's a sign that the bulls are a little bit stronger. However, we got this breakout and formed another range. The upper range did overlap the lower range by a little bit. Every time you get a reasonably strong breakout, the market is telling you that the price is still too low. It has to find sellers, and it has to go higher to find them. Again, I mentioned that in this particular case, even though there's a 60% chance the range will overlap the prior range, there's a 40% chance it will not. And here we have a gap, the top of the lower range and the bottom of the upper range. A sign of strong bulls. The bears were unable to close the gap, and it increases the chances that we're going higher. So when you're starting to get this breakout, you have to assume there's actually better than a 50-50 chance that the breakout will be successful. Here we do have overlap. The third trading range overlaps the second, and it's a sign that the trend is weakening. Strong bear breakout, bear microchannel, a lot of consecutive bear bars closing near their lows. Chances are we're going at least a little bit lower. Maybe this is a little bit lower, maybe this is a little bit lower. But big down, big up, probably trading range. And then we have another bear breakout lasting a few bars. In fact, only 1 or 2 bars below the low of the upper range. As usual, 60% chance the top of the lower range will overlap the bottom of the upper range by at least a little bit. And after 20 or 30 bars, it's in breakout mode, and you can get trend resumption down or trend reversal up. The probability of the two is about the same after about 20 or 30 bars. In this particular case, the market decided that the price was too low and it had to go higher to find sellers. And this is common. At the end of the session, the market decides, will the bear trend resume? Will it reverse like it did here? Or will it simply continue sideways into the end of the day? You can see videos on trading ranges and trading the end of the day for more information about what takes place at the end of the session. Again, the euro versus the dollar, a 5-minute chart. There's actually a wedge bottom here. Can you see it? 3 pushes down, 1, 2, 3. I know the second push falls below the line connecting the first and third, but that's common. We have a bear trend, and then late in the bear trend, after 20, 30 bars, here after 50 or 60 or 70 bars, the market enters a triangle. Triangles rarely are perfect, but this is one way to draw it. A high, a second push, a third push. Again, does not matter that the second is above the first. The overall idea is that we're narrowing, we're getting to a narrower, tight trading range. And we have at least 3 pushes up or down. 1, 2, 3. You can argue 3 down. 1, 2, 3. A bull breakout that reversed. And then you can restart the count. 1, maybe 2, and then 3. In any case, it's a breakout mode situation. When you do get a triangle late in a trend, here we got a bear trend, and you get trend resumption, you have to think that the odds are usually 60 or 70% that the triangle will be the final bear flag and that it will lead to a reversal, as it did here. And it did in the form of a wedge. Probably will get at least 2 legs sideways to up, 1 pullback 2. I'm finally going to be talking about trends that are in broad channels. We're in a bear trend, and we have deep pullbacks, but in general, still forming lower highs and lower lows. It's a stairs pattern. Here's the breakout, but the pullback goes above the bottom of the breakout. Here's the breakout point, and the pullback goes above the breakout point, and all the way down. Here's the breakout point, and we have a pullback above the bottom of the breakout point. Here's another breakout, and it reversed up back above the bottom of the breakout. And when the pullbacks overlap the breakout points, I call it a stairs pattern. We're stair stepping down. Pullback above the breakout point. Pullback above the breakout point. So that's a stairs pattern. And that's important to recognize. That tells you that bulls who are buying at this low and scaling in lower are making money. And that is a sign of a weak trend and a sign that the market will probably enter a trading range before too long. A broad bear channel always has 20 or 30 bars in it that are also in a trading range. And a lot of times when you look at the chart, you're not sure if it's in a bear trend or in a trading range, or if the bear trend has ended and converted into a trading range. When you're not sure whether it's still a bear trend, a bear channel, or a trading range, does not matter. You trade it like a trading range. You look to buy low, sell high, and scalp. So you buy low, buy in the bottom third, and you scalp somewhere in the middle. On rallies, when they reverse down, you sell them. Since we still are in a bear trend, you can swing trade the sell-offs, the bear entries, but in general, a lot of traders simply scalp them because they're not sure whether the trading range will continue for a lot more bars, and they'd rather just sell and scalp, sell and scalp, sell and scalp. A lot of times when the market is selling off like this, and then you enter a trading range, you're not sure what's going on. Are we forming a wedge? 1, 2, 3. Are we forming a lower low major trend reversal? Are we forming a trading range? We're getting lower highs and lower lows. The answer is all of that. It's obviously still in a bear trend. It's obviously in a trading range, and it's obviously forming a wedge bottom and a lower low major trend reversal. Because it is still in a bear trend, a lot of traders will swing at least part of their position when they're selling. For the longs, we're not yet in a bull trend, so any long is a scalp. So traders taking counter trend positions, here the trend is down, so the counter trend position is buying. A bear trend, so when you're buying only for a scalp. Traders will sell reversals down from the top of the channel. The channel, it rarely is exact. Sometimes on television or on the web, you'll see channels that look perfectly parallel, but that's not how channels typically look. The channels are rarely exact, and you have to keep redrawing the lines. And anytime the market is near the top of the channel, look to sell reversals down. We're in a bear trend, so it's less important to buy reversals up from new lows, although when traders see a lot of two-sided price action and they start to see pullbacks going above breakout points, a lot of traders will buy reversals up from new lows for scalps. Three pushes down, 1, 2, 3. Second entry for a failed breakout below a prior low, common in trading ranges, so some bulls will buy that at least for a scalp. Double top bear flag and a bull breakout. You can say head and shoulders bottom, left shoulder, head, right shoulder. However, we're still in a bear trend, and you have to be ready for the bull breakout to fail. When you have a double top and a bull breakout that fails, I think of that as a variation of a wedge. We have 3 pushes up, 1, 2 for the double top bear flag, and then the bull breakout is the 3rd push. For me, functionally, this is the same as a wedge bear flag, and I'm expecting at least a couple legs sideways to down. 1, pullback, 2. A reasonable sell, failed breakout above a double top bear flag, another lower high in a bear trend, and a decent sell signal bar. Traders at this point redraw the channel that way. We got a breakout above the channel, another reversal down. Traders will sell below that bar, even though it's a bull bar. We have another double top, bear flag, and a bear channel. A new low, stair stepping down. Traders will buy a reversal up, or they'll simply buy at that low, and then they're willing to buy more lower. Again, when you're buying in a bear trend or in a trading range, it's better only to scalp. After every reversal down, you redraw the line, and then when you test that new line, traders will look to sell a reversal down again. After every new high, you draw a new line, and you see how the market behaves at that line, and you sell a reversal down here or a reversal down there. You can draw the line that way, you can draw the line this way, or you can simply say another new low in a broad bear channel, so traders should buy reversals up, or they simply buy at that prior low, looking for a scalp. Bears, they also look to sell somewhere in the middle of the last bear leg. So we have a bear leg. Here's the middle third of that bear leg. Traders will look to sell somewhere in the middle third. For example, a breakout into the middle third, and then we have a bear bar reversing down. So traders will sell below there or below here. Another bear leg starting here or here. This is the middle third. Traders will look to sell somewhere in the middle third. If they get a reversal down, for example, we're breaking out to the upside. Traders will look to sell below the low of a bar, betting that a pullback to the middle third of the prior bear leg will result in another lower high. We're getting lower highs. The same here. Most recent bear leg, traders look for a pullback somewhere to the middle of that bear leg, and then they sell a reversal down, expecting another new low in the bear trend. And bears take profits at the prior lows. So the bears who sell here will take at least partial profits at the prior low. The bears sell here, they'll take profits around the prior low. Bears who sell here, they'll take profits around the prior low. Bulls who buy, they're looking to scalp out somewhere in the middle third where the bears are going short. So for example, a bull who places a limit order to buy at this low, he gets filled. He'll look to sell, take profits for a scalp somewhere in the middle third. And one way to do it is either with a limit order at a certain number of ticks or pips, or simply sell the reversal down, take your profits there. A bull buying at this low sees the market continuing down. However, he's confident that because we're in a stairs pattern, we're going to get back above this breakout point. So some of the bulls who buy here will buy more down here. Their second purchase is at least the size of a typical scalp. Because if it does continue down like this, a lot of them will try to get out around their first entry, break even on their first, and with a scalp on their second. So they want to make sure that that second entry is at least the size of a scalp below the first. So you buy here, buy more here, and then look to exit around the original entry. Bears, they're looking to sell around the middle third anytime there's a reversal down. Here we have a breakout and a pullback below the breakout. A breakout and a pullback below the breakout. So it's a stairs pattern. But what do you notice about this stairs pattern? The size of this breakout from this high to that high is less than the size of the breakout from this high to that high. So the stairs are shrinking. The bulls are less confident that the market's going to continue higher, so they're quicker to take profits. The bears are more confident that it's going to evolve into a trading range soon, and they're more eager to sell. So the height of this breakout is 2 ticks, and the height of that breakout is only 1 tick. It's also 3 pushes up, 1, 2, 3, so a wedge top. When you see a shrinking stairs pattern, you have to be thinking that the bull channel is probably ending and that the market will soon evolve into a trading range. Once it falls below a major higher low, then the pattern of higher lows is no longer still intact. And if the market's not making higher lows, it's no longer in a bull trend. It's either in a bear trend or a trading range. This sell-off is not particularly strong. It does not have consecutive big bear trend bars, and it's finding support at that major higher low. This looks more like a bear leg in what will become a trading range. In any case, it's no longer a bull trend. Here are shrinking bear stairs. That's the size of that breakout. The next breakout is smaller before the bulls come in. Next breakout smaller, next breakout smaller. Well, the bears are taking profits faster and the bulls are more eager. 17 pip breakout before we get a pullback. Over here, the market only fell 6 pips below the breakout point before we got the pullback. And then we ended up with a double bottom, higher, low, major trend reversal. Head and shoulders bottom, left shoulder, head, right shoulder. The loss of momentum, the loss of strength on the part of the bears means that the bear trend probably is ending and the market will probably enter a trading range or possibly a bull trend. And once you break above a major higher low like this, a strong bear breakout to a new low, so this higher low is major. Once you break above it, the market is no longer in a bear trend. It's then either in a trading range or in a bull trend. And at this point, you can say, well, that's a bull trend. Well, not necessarily. We're still below the top of the bear trend, and this might simply be a bull leg in a trading range. In any case, it's no longer a bear trend. Here's a daily chart of the euro versus the dollar. Again, a trend continues as long as it's making major higher lows. We have a series of higher lows and higher highs, so we're in a bull trend. But we're getting very deep pullbacks. And some of the pullbacks are strong enough so that traders would conclude that the market is always in short, no longer always in long. Yet we're still forming higher lows and higher highs. So even though there are times when the reversals down are enough to make traders believe we're always in short, the big picture is we're still in a bull trend. When you have a bull channel with very deep pullbacks, strong bear pullbacks, but we're continuing to form new higher lows, it's a broad bull channel. The bulls are looking for pullbacks to the middle third or so of the prior bull leg, and they'll look to buy in the middle third, or they'll buy a reversal up. Here, a bull trend, a bull leg. Here's a pullback into that middle third. Bulls are looking to buy here. Another leg up. This is the middle of that leg up. The bulls are looking to buy somewhere in the middle of that last leg up. Higher probability of profit if traders are buying above a bull bar or after a second leg down. So 1 pullback, 2, micro double bottom, small bull bar. Higher probability buying above that. 2 legs down, 1 pullback, 2. Does not really look like 2 legs, but it is 2 small legs. And then 1 pullback, 2. Maybe this is already 2 legs, double bottom. So it might be 1 and then new high, but part of the correction from this high, and 2 legs down. But anyway, it's a double bottom. In the middle third, traders will buy a reversal up. Micro double bottom, they'll buy a reversal up. Wedge bull flag, 1, 2, 3, they'll buy a reversal up. We're still in the middle third, they'll buy a reversal up. And bulls are taking profits at new highs. You know that because the market is going down. The market makes a new high and it goes down. That means traders are selling. Bulls are selling to take profits. Bears are selling to go short. Even though the breakout here was strong, look what happened. The pullback eventually fell below the top of the breakout. And that's telling us that it's okay to start selling at new highs using wide stops and scaling in. Bears sell new highs for scalps. Here, they probably would sell more here and get out break even on their first entry with a profit on the second entry. Here, it immediately went down, so they simply scalp out somewhere in the middle third of the last bull leg. Here, a bear would sell, it keeps going up, sell more, and then try to get out, break even on their first entry, and then with a profit on their second entry. If they sell at the prior high and it immediately goes down, they simply take their profits somewhere in the middle third of the most recent bull leg. Same here. They sold, did not go up high enough for them to scale in, but it did pull back into the middle third of the most recent bull leg, and they took profits. In this video, I talked about 3 types of trends: a trend from the open trend, a trend that begins on the first bar or second or third bar of a session. I next talk about trending trading range days, where early in the session there's a trading range, but the trading range is only about half of the height of a typical daily range, so traders expect the range to double. And finally, I talked about broad channels. For example, a broad bull channel has deep pullbacks, and sometimes the sell-offs are so strong the market is always in short, at least for a little bit, yet it reverses up from a higher low. So the series of higher highs and higher lows continues, and therefore the market is in a bull channel, which is a type of bull trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on trends. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on trends. In this video, I'm going to be talking about tight channels, which are strong trends, and I'll also talk about small pullback trends, which are the strongest types of trends. Sometimes you see a trend like this. We've got a spike up and then a channel, and it's difficult to know if this is still part of the breakout phase or if it's part of a channel. On a higher time frame chart, it is part of a breakout. And if it's difficult to tell whether it's a breakout or a tight channel, assume it's a breakout and trade it like a breakout and only look to buy, because it is a breakout on a higher time frame chart. And it's clearly a bull trend, so you should only buy. Can you sell? I would only buy. Whenever the market is in a fairly tight bull channel, it's a breakout on a higher time frame chart, it's much easier to make money looking to buy. The odds of making money as a bear are small, so better only to look to buy. So let's say this is a 5-minute chart, and it's a fairly tight bull channel. A tight channel is weak compared to a breakout, but it's still a pretty strong bull trend. The pullback only lasted 1 bar. Pullback only lasted 1 bar. Here, no pullback at all. Even if you do get a reversal, it's probably minor, and you're probably going to get at least a little bit more up. So I think of a tight channel as a strong trend, and I trade it like a breakout. And as I said, on a higher time frame chart, it is a breakout. So for example, 5-minute chart, this green box here, this green box is the same bars, but this is a 15-minute chart. And it's clearly simply a strong breakout, and you don't want to be selling. So you only want to be trading in the direction of the breakout. Tight bear channel, the pullbacks are small, they're not going very far up, and the channel down is very tight. It's a breakout on some higher time frame chart. There are always different ways to draw the channel. This is one way. You can also draw it that way as well. And it does not matter. When the pullbacks are small, you only want to be looking to sell. And here we get a gap this low, these highs. The market's forming gaps, but you only want to be selling. And if you want, you can sell with stops on reversals down. So you wait for a reversal up to fail, and then you keep looking to sell below the low of the prior bar, betting that the bull reversal will fail and that the bull reversal, in fact, will simply be a bear flag. Here, you sell. Does not matter if this goes above that. We're still forming lower highs, major lower highs. This is a minor lower high, minor lower high. So it does not matter that we go above it. Traders should only be looking to sell when the channel is this tight. It's a breakout on a higher time frame chart, so you only look to sell. And these gaps that we're getting are a sign that it's a very strong bear trend and you should not be buying. Bull breakout, a channel. We have pullbacks, we have some bear bars, but the pullbacks only last a bar or so and they do not fall very far. And on a higher time frame chart, it's a breakout. Many ways to draw the channel. This is one way. And you could also draw it like that. And the channels, they're never perfect. They're rarely perfect. Doesn't matter. When the channel is very tight like this, only look to buy. Every time you see a reversal attempt, expect it to fail and become a bull flag, and then buy with a stop above the high of the prior bar. Gaps. We have a reversal attempt, but the low of the reversal could not fall above the high of the breakout point. Again here, bull breakout, tried to fail, tried to reverse here, but these bars held above the breakout point, and that is a sign of a very strong bull trend, so you do not want to sell. This is unlike a broad channel where the pullbacks last 5, 10 bars or more, and sometimes the breakout is strong enough to make the market always in short. So we got a big breakout bar and a follow-through bar, probably always in short, but we're still getting higher lows, and this still could be a broad bull channel. A broad channel like this, to me, is basically a trading range that's sloped upward, and you can trade both as a bull and as a bear. But because it's a bull trend, in general, it's easier to make money buying. It's also a pair of trading ranges. We had a trading range and then a breakout and another trading range. And that's often the case. That's usually the case whenever the market's in a broad channel. It's usually also spending a lot of time in trading ranges. Trading range, two-sided trading, traders tend to buy low, sell high, and scalp. So whenever the market is in either a trading range or a broad channel, traders will often trade in both directions. And they'll take quick profits because they believe the market's not going to go very far. So they buy low, sell high, and scalp. So whenever the market falls somewhere in the middle third, they look to buy. Anytime it goes to a new high, they look to sell. And they take quick profits because they believe the market's not going to go very far. So you got a bull channel. Is it tight or broad? Well, sometimes you're in that gray zone where you don't really know. Here we got a 2-bar pullback, well, 1-bar pullback here, 2-bar pullback here, a little trading range here. Is it a tight channel or is it a breakout? On a higher time frame chart, it's probably a breakout. But whenever I'm looking at any chart and I'm deciding broad or tight channel, I always assume tight, and therefore I only want to look to buy until there's more evidence that the market is two-sided. If you cannot tell broad or tight, only look to buy, like in this example. So every time the market tries to reverse or pause, look to buy with the stop as the market reverses up. Small pullback trend, the strongest type of trend. And it usually is also some other type of trend as well, like a trend from the open, a spike in channel trend. A lot of times there are small trading ranges, so it's a trending trading range day. And the pullbacks, I said it's a small pullback trend, so the pullbacks are small. They typically do not fall very far, and they typically do not last for many bars. So 1 bar here, 1 or 2 bars here. We're getting reversal attempts, and a lot of the rally in a small pullback bull trend looks like a bull leg in a trading range. You're not getting consecutive big trend bars. You're getting bars with a lot of hesitation, tails on top, bear bars. And that is a warning that either it's a bull leg in a trading range, or if you're starting to get gaps or negative gaps, pullbacks just dipping a little bit below breakout points or not dipping below at all, Even though it looks like a bull leg in a trading range, it's probably a small pullback bull trend, and it's probably going a lot higher. So a pullback's just lasting a few bars, no consecutive big bear bars. The pullbacks are all less than twice the size of an average bar. While any type of trend can begin any time of the day, small pullback trends usually begin in the first hour or so. And again, the pullbacks are less than twice the size of an average bar. And one of the most important characteristics is gaps and negative gaps. So once you start to see a rally that looks weak, it lacks consecutive big bars, but it's forming gaps, you got to be thinking, uh-oh, this is one of those small pullback trends that Al talks about, and it's one of the strongest types of trends, and therefore I should only look to buy. And these trends are breakouts on higher time frame charts. So here's a 5-minute chart, small pullback bear trend. And this is what it looks like on a 30-minute chart, a higher time frame chart. Almost all bear bars, mostly a bear microchannel. So it's a bear breakout. Each of these pullbacks means that it's a channel on the 5-minute chart, but the absence of pullbacks on the 30-minute chart means that it's a breakout. Because this channel is a breakout on a higher time frame chart, the 5-minute chart is much stronger than it appears. A breakout is the strongest type of trend, and it usually leads to some kind of a measured move. If you have a small pullback bear trend, you know it's a breakout on the higher time frame charts, and you know it's therefore one of the strongest types of trends, even though most of the time it keeps looking like it's a bear leg in a trading range. These gaps that I talked about are really important. They make it likely to be a small pullback bear trend rather than a trading range. So look at this. We got a breakout here below this breakout point, did not overlap. And we got a breakout here, did not overlap. The pullbacks are not going over the breakout points. And that is one of the hallmarks of a small pullback trend. If you're getting gaps, especially if you get 2 or 3 gaps, that's a warning that even though each little part of the trend looks weak, it's a very strong trend in the market. It's probably going a lot lower. So do not look to buy. You certainly don't buy until you start seeing some transition into a trading range. You need to see some sign of strength on the part of the bulls. The bulls need to start closing gaps, like here. So breakout point, here's the breakout point, the pullback went above the breakout point. So maybe the market will soon begin to transition into a stairs pattern and then a trading range. In these very tight bull channels, small pullback trends, the market's always trying to reverse, but the breakouts will fail and become bull flags. And usually later in the day, after 3, 4, 5 hours of trading, if you're trading stock index futures, a lot of times around 11 o'clock, 10 o'clock, sometimes 12 o'clock, but usually around 11 o'clock, 11:30, you get a breakout that is 50% to 100% bigger than the biggest prior breakout. So here's the biggest prior breakout, and then here we got one that's about 50% bigger. And it's an attempt by the bears to take control and reverse the market late in the day, but chances are the bears will fail and the reversal attempt will become a bull flag, and a lot of times it goes up to a new high at the end of the day. We have a very strong breakout, another breakout, and then a very small pullback bull trend. You can call it simply a tight channel. Sometimes you get a bigger reversal late in the day. This is so extremely climactic, it's not a surprise. And sometimes you get a sell-off into the end of the session or into the close of the day. Here we're sideways for 20 or 30 bars, and now we got a double top major trend reversal, and we just sold off slightly into the close. Sometimes you'll get these small pullback trends, and they actually will reverse. Here we got a spike in channel, maybe a parabolic wedge, 1, 2, 3, nested 1, 2, 3, and then you start to get an endless pullback in a tight channel like that, you're going to be thinking that the market might be seeing this as a parabolic wedge. And if it does, a lot of times you'll get a breakout after 20 or 30 bars, and then you convert into a bear trend. We got a bear breakout, bear follow through. You can say, well, Al, these are gap bars. There's a gap between the high of the bar and the moving average. Won't that lead to a test of the bull trend high and then a major trend reversal attempt? Well, it typically does, except that this endless pullback in a tight bear channel has gone on for 20 or more bars, and that's making the market pretty neutral. So this bull reversal may not get very far. You can see the bad follow through in the market failing to break strongly above the moving average. Is it now a small pullback bear trend? Usually I don't think of it that way. So I think of a small pullback bull trend and then an endless bear pullback. But to me, this is a real problem for the bulls. This is so climactic, unsustainable. And now we have an endless pullback and a bear breakout and a reversal up. Could not get above the top of the bear breakout. This might be the start of a bear trend, this bear breakout bar. So you got to be ready if the market starts to sell off, especially once you get another bear bar and a bear follow through bar. Traders start to sell closes and they sell above bull bars, betting the reversal up will fail. Usually, if you have a small pullback bull trend, you do not get a reversal. This is really more of a spike in channel bull trend or a parabolic wedge bull trend and less of a small pullback bull trend. I typically don't call this a small pullback bull trend, although it clearly is. To me, it's just so climactic and so extreme. I think of it more as a biclimax. Remember, I said that small pullback bull trends typically they have weak bars, a lot of doji bars, prominent tails, bear bars. It looks like a bull leg in a trading range. That's not the case here. This is much more of a parabolic biclimax, parabolic wedge biclimax. This is more of a small pullback bear trend. We got a lot of bars with tails. We've got some gaps. Does not look especially strong. No big bear bars. We're getting bad follow through bull bars. But here we got a bull breakout and a higher low. So it's possible that this is a higher low major trend reversal. And this is maybe a final bear flag, low too short, two legs up, one pullback two, so a low too short and a wedge bottom, and then a higher low major trend reversal. So possible start of a reversal up, which we got. Less common after a small pullback bear trend, but you still can get it. Higher low major trend reversal. Some will say this is the higher low major trend reversal. This is a double bottom with this bear bar. Other computers will say the double bottom is here. So it's a double bottom, higher low major trend reversal. Small pullback trends are also tight channels. That only makes sense, right? If the pullbacks are really small and the market is trending higher, it's going to be in a tight channel. Pullbacks are usually less than 2 to 3 times the size of the smallest scalp. Here we have a bigger pullback late in the day. Usually it fails and you get trend resumption up. And you redraw the channel. So we have a tight channel here, we broke below it, and now the market's resuming up. You redraw the channel and the distance between the lines is now greater. Channels as they mature, trends as they mature, typically become weaker and the channels tend to become broader and flatter. So flatter, the slope of this new channel is less than the slope of this original channel. Whenever you think the market might be in a fairly strong bull trend, do not sell. Here we got a bull breakout. Do you want to sell for a failed breakout? I would not. Not yet. A lot of the beginners like to sell in bull trends because the stop is close, but they ignore probability. And whenever you're taking a trade with a low risk, a small risk, chances are you're going to lose. The probability is going to be low. And if you get enough of those small losses, 3, 4, 5 small losses, it can add up to a pretty big loss. So whenever you're in a market where the pullbacks are very small, even if you see a lot of weak-looking bull bars, do not sell, because on a higher time frame, it's a bull breakout. So if a trader sells here, he gets stopped out. Trader sells here, he gets stopped out. Trader sells here, probably will get stopped out. A lot of bulls are afraid to buy because the rally looks weak. Tight trading range with dojis, bull bar bad follow through, bull bars with dojis, the bull breakout not all that big. So bulls end up getting trapped out. At least weak bulls do, because they know where their stop is. The stop is way down here, so they don't want to be buying too far up in a rally that looks weak. But if the market is forming gaps and not much in terms of bear bars, it's perfectly good to buy for any reason and just use the appropriate stop. Beginners, they just look at the dojis and say, oh, strong bull trends do not have all these dojis, so it cannot go higher. In general, that's true. Breakouts do not have all those small dojis, but small pullback bull trends, they do have a lot of small dojis, and the market is in one of the strongest types of trends. You don't want to be selling. The wider the stop you use on any trade, the higher the probability is that you make money. When you do lose, you obviously lose more than with a tight stop. But as a general rule, if you use wide stops, you're increasing your risk, but you're doing that to increase your probability. So wide stops usually mean higher probability. Tight stops usually mean low probability of making money. So you know where the stop is. Initially, it's down here. And then you see a bull breakout or somewhere up here, you raise the stop to here. After you see 3 or 4 or 5 bars up, strong breakout, this becomes a major higher low, so you raise the stop. The strong bulls, they see the doji bars and they see the bear bodies and they know the trend does not look all that strong, but they also recognize it as a small pullback bull trend day. They see gaps and negative gaps with a lot of trading range price action, and that usually means the market is going to go higher, small pullback bull trend. And they buy for any reason. You can buy reversals up from bear tops, you can buy stop orders, you can buy at the market. And then every time you get a reasonably strong breakout, especially with follow through, you tighten your stop to just below the breakout or just below the most recent higher low. Strong breakout, move the stop from here to there. Bulls buying above these bars, betting on a bull flag. Once you get this breakout, you raise the stop, and this becomes a major higher low. Major because it has both decent bull bars and it's a new high. One other thought about this. This is the best looking bull bar probably. We got one comparable here, but certainly one of the best 1 or 2 bull bars, and it's occurring late in a bull trend. So that's an increased risk of exhaustion. Exhausted bulls do not necessarily sell enough to create a short, a bear trend. Usually they do not. However, they usually do sell enough to create a trading range. So if you start to see a surprise bar like this late in a bull trend, 30, 40, 50 bars, it's an opportunity to take profits. Sometimes when you get these small pullback bull trends, they stay above the average price for a lot of bars. This is maybe 30, 40 bars above the moving average. And that means bulls are really aggressive. They're willing and eager to pay above an average price for 20 or 30 bars. So what do you think will happen when it finally gets down to an average price? Well, the bulls will buy. They've been buying above an average price for a lot of bars. So if they finally get a chance to buy at the moving average, they usually take it. Also, whenever the market's above the moving average for about 20 bars or more than 20 bars, I think of it as a 20 gap bar buy setup. And a lot of bulls will place limit orders to buy the moving average, at least for a scalp. Also, a lot of Bulls will look for the first bear close below the moving average, and they'll buy that bear close, betting that it's a trap, and it usually is. So here you have a 20 gap bar buy. You can buy the moving average or place a limit order to buy one tick above, or you can buy these gap bars, betting that the trend is so strong we will resume up to a new high. Bulls, as I said, try to buy the first bear thing. So the first time there's a pullback below the low of the prior bar, they buy it. First time there's a break below a minor higher low, they buy it. First test of the moving average, they buy it. First bear close below the moving average, they buy it. First big bear trend bar below the moving average, they buy it. Gap bars, as soon as they see bars with a gap between the high of the bar and the moving average, they buy. They can either buy the gap bar or they can buy the reversal back up using a stop. And here we have a moving average gap bar, a gap between the high of the bar and the moving average. So bulls will buy on a stop just above the high of that bar. And even though we're getting a lot of sell-offs here, we're still making higher lows and higher highs. Gap bars, it's a sign that the bulls are losing control, and it's a sign of strong bears. They're able to put a bar completely below the moving average. So when you get gap bars in a bull trend that's going on for 2 or 3 hours, the rally that follows the gap bars usually will be the final rally before the market attempts a major trend reversal. E-mini, trend from the open bull trend, very strong bull breakout, pullback, and then we're just moving up. Again, when it's this strongly up, I tend to think of it more as just a breakout and an extended breakout on a higher time frame chart. I also am aware of the possibility that it could be a parabolic wedge top. Small pullback bull trend, also a trend from the open bull trend, and spike and channel bull trend. So spike, pullback, channel, or the whole thing is a spike, pullback, channel. Again, most trends have a spike and channel trend within them. First pullback in about 15 bars or so. First pullback in about 15 bars or so. Bulls will buy it, and pullback, you got to be thinking that a channel will follow. And here we got a 14 tick pullback, and the first pullback to the moving average in about 50 bars. Small pullback bull trend. You always look for a bigger pullback later in the day, usually about 50 to 100% bigger. Here we got a 14 tick pullback, and here we have a 31 tick pullback. A lot of bars that do not look particularly bullish. A lot of small bars, a lot of dojis, a lot of prominent tails, a lack of consecutive big bull bars closing on their highs. One of the characteristics of a small pullback bull trend. And then, most importantly, in addition to seeing weak bars, I want to see gaps, at least one or two. A pullback held above a breakout point, and again here, that's a sign of very strong bulls, and it increases the chances that we'll get some kind of a measured move up. And in fact, here, measured move from the bottom of the bull trend to the top of this rally takes us up to about the high of the day. So from the low of the day to this breakout point, measured move up. This is the euro versus the Canadian dollar, and this is the approximate start of the Asian session, and it began as a small pullback bull trend. A lot of weak-looking bars, dojis here, not particularly big bull bars here, a lot of reversal attempts, but it's still a small pullback bull trend. A lot of dojis common in small pullback bull trends. But look at the size of the pullbacks. 13 pips, 17 pips, 22 pips. They're all pretty small. The entire rally went up 115 points, and the biggest pullback was only 22 pips. So very small pullback in the bull trend. A lot of dojis, a lot of prominent tails, the absence of consecutive big, strong bear trend bars. You have to be thinking about small pullback bear trend. Next, you look to see if there are gaps. And if there are gaps, the day is probably a fairly strongly bearish day. I always measure the size of the pullbacks. So 17 pip pullback here, 19 pips here, 14 here. And here we fall 140 points. And the biggest pullback was only 19 pips over here. Again, lots of dojis. It looks like probably a bear leg in a trading range. But once you start to see gaps, you got to throw out that idea of a bear leg in a trading range. And instead, you have to assume small pullback bear trend and that we're going to work lower. One of the hallmarks of a small pullback trend is gap formation. So if you start to see gaps, yet the bars do not look particularly strong, you have to assume that the market is much stronger than what you think. Again, you can see we have a gap. It became the measuring gap. And a lot of the bulls got out here, even though the market continued sideways for a couple of hours. In this video, I talked about tight channels and how they are breakouts on higher time frame charts. You only want to be buying in tight bull channels. You only want to be selling in tight bear channels. Next, I talked about small pullback trends, which are typically one of the strongest types of trends, and they can last a long time. They always look bad. They always look like they're forming legs within trading ranges. But once you start to see gaps, even if the gaps are not particularly impressive, you have to assume that it's a small pullback trend and not a leg within a trading range. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on trends.